Stat from the June jobs report, average hourly earnings were up 3.6% year on year, bringing wages up to a record high of over $30 an hour. According to Morgan Stanley, it's showing no signs of slowing down. They've identified industries where companies face high risks from these labor cost pressures. And joining me now is Adam Vergadamo. He's head of U.S. thematic investing and equity strategist at Morgan Stanley. Adam, it's good to have you. So a lot of these are retail and restaurants, right?
Absolutely, right. That's where you would expect some of the pressures to show up, just based on how important the cost of labor is to the operating model and how thin margins are at the end of the day.
What are some of the more surprising places it's showing up?
So I guess some of the more surprising places, you previewed it in your intro here. I think waste management among them, education services. I think there's an important distinction to make within the restaurants or the lodging space, for instance. You have to be really careful to separate out franchisors versus non-franchise models, right? Who's exposed to operational risk, who is not. Casinos are much better insulated, we think, than traditional lodging firms or lodging REITs from this. So there's really a lot of nuance to measuring this, both in terms of labor intensity and where wages are rising.
Why are casinos relatively better off?
Well, casinos are better off because they're just less labor intensive, or put another way, they make significantly more profit per employee, right? If I have, let's call it $60,000 in EBITDA on average, a profit per employee, I have more cushion to absorb rising wage pressures than I do if I'm operating a business model that produces, say, $15,000 in EBITDA per employee. I'm just more exposed. So casinos are better off there. The other thing that our gaming and lodging analyst, Thomas Allen, does a good job of pointing out is particularly Las Vegas casinos, they're one of the only games in town for employment. So if you're not working in one of these employments around the Strip, it's harder to find a job elsewhere. So the bargaining power shifts a little bit in that local market is how we think about it.
So I would, if I'm an investor, I look across here and I go, okay, maybe I don't want exposure, but then I see names like Chipotle. Under Armour's even been, performing better lately. I mean, are there reasons why these companies can do well because people give them credit for, this is going to be a passing issue or an issue that you deal with, but ultimately you have strong demand, versus an issue where they have to make some existential changes?
Well, I think that's the debate, right? And the reality is we don't really know. So what we tried to do in the report was systematically screen the broader equity universe on three metrics, Kelly. One was that labor intensity I mentioned. The second, using BLS data that was very granular by industry, how fast are wages rising? They're not rising every place at the same pace, and that matters. And the third metric is an expectations game, right? You know as well as I do, markets are about expectations relative to reality. So we wanted to look at where margin expectations are high, both relative to history, for the margin accretion expected over the next year or so, to kind of suss that out across those three metrics to get at exactly that dynamic. Where is it perhaps priced? Where is it not? And the other lingering thing that we don't know the answer to, but why we brought in those margin forecasts, what's demand? What is the elasticity of demand? Your last speaker series was talking about Uber and trying to pass along some of that price. Elasticity of demand came up a couple of times. That's the potential offset. We know companies aren't trying to sit still, but what we wanted to do was help relatively quantify where the risks are or where the hurdles are perhaps higher, where those actions would be more necessary to take price to offset.
Shepard Smith here. Thanks for watching CNBC on YouTube.